Welcome, curious minds, to another deep dive. Today, we're putting a spotlight on LIC Housing Finance Ltd., specifically their Q1 FY26 financial results, a really significant player in India's housing finance space.
Absolutely.
Our mission here, well, we've got the official press release, the investor presentation, all those key documents you've shared with us, and we really want to distill them, extract the most important nuggets of knowledge, give you a clear, comprehensive, and hopefully genuinely engaging understanding of how this major company performed and what those numbers really mean.
That's exactly right. Because, looking at these reports, it's not just about reading out figures, is it?
Not at all.
It's about understanding the health, the pulse, really, of a major financial institution.
Right.
Seeing its strategy in what's, let's face it, a pretty dynamic market.
Definitely.
And thinking about the potential implications for the broader housing sector in India.
Yeah.
So just to set the stage, we're covering the quarter from April 1st to June 30th, 2025.
Okay, let's unpack this then, starting with some of those impressive headline figures. Total revenue from operations, it grew by a solid 7% year on year.
Yeah, quite strong.
Reached 7,233.13 crores. And the net profit after tax, the PT, that increased by 5%, coming in at nearly ours. 1,360 crores for the quarter. That's up from about 1,300 crores same time last year.
So decent growth on both the top and bottom lines there.
Exactly. And net interest income, the NII, stood at ours 2,065.78 crores. That's up 4% from Q1 last year.
Right.
The overall loan portfolio, the outstanding loans, saw 7% growth too. Reached a pretty massive ours, 309,587 crores.
Wow.
Yeah. And specifically, the individual home loan portfolio grew 7%. The project loan portfolio, interestingly, grew 10%.
Okay, so project loans growing a bit faster in the overall book.
In the overall book, yes. But then look at disbursements. Total disbursements were up 2% overall, reaching ours 13,116 crores.
Right. And what's fascinating here, I think, is while the overall number is up slightly, if you look closer, there's a really interesting shift happening.
Oh.
Well, individual home loan disbursements, their core business, right? They were up 3% to ours, 11,247 crores, which is, good, solid growth.
Right, steady.
But the project loans disbursements, they saw a huge decrease, dropped 70%, 70, down to just ours 156 crores compared to over 500 crores in Q1 FY25.
70%. Wow, that's quite a drop.
It really is. And it kind of connects back to that 10% growth in the outstanding project loan book. It suggests maybe they had some big disbursements previously that are now just part of the existing book, but new project lending really slowed down this quarter.
So it really highlights their focus on the individual side, maybe being more cautious on the project front.
Exactly. It clearly signals where their focus is or maybe where they perceive the risk-reward balance to be right now. Strong focus on individual loans, perhaps a strategic pullback, or just a quieter quarter for project finance.
Interesting. Okay, so that's the top line and the loan growth story. Now, here's where it gets really interesting for any lender. Profitability, margins, let's look at the net interest margin, the NI.
Yeah, the NIM, always a key metric.
So for Q1 FY26, it stood at 2.68%. Now, that's actually a slight decrease from 2.76% in Q1 FY25.
Right. And on the surface, you might think, oh, lower NI, that's not great. But you really have to dig into the components.
Okay, break it down for us.
Well, first, the good news. Their weighted average cost of funds, basically what they pay for their borrowings, actually decreased. Went down to 7.50% from 7.76%. That's a positive trend for costs.
Low funding costs, always good.
Definitely. Now, the yield on advances, what they earn on their loans, that also decreased slightly to 9.60% from 9.83%.
Okay, so both costs and earnings yields came down a bit.
Correct. But here's the really fascinating part, I think. Their spreads. The direct difference between the yield on advances and the cost of funds actually improved slightly. Went up to 2.1% from 2.07%.
Huh. So the core profitability on new lending or the marginal business actually got better.
Precisely. The spread is really the core engine room, isn't it? It suggests better pricing power or efficiency on the business they're doing.
So how do we reconcile that? Improved spreads, but a slightly lower overall NIM.
Yeah, it's a good question. It could be a couple of things working together. Maybe the overall mix of assets changed. Perhaps, lower yielding assets grew a bit faster proportionally within the large existing book.
Right, affecting the average.
Or it could just be the math of averages. Even if new loans are more profitable, better spread, the sheer size of the existing loan book and how its average yield behaves can pull the overall NIM down slightly. And we absolutely have to remember, 99% of their loan book is pure floating rate.
Ah, yes. highly sensitive to rate changes.
Extremely. So any shifts in the benchmark rates directly impact their yields and consequently the NIM. The key takeaway for me is that core profitability, the spread, is improving, even if the overall NIM saw a slight dip this quarter, likely due to those other factors.
That makes a lot of sense. It's a nuanced picture. Okay, moving from margins to maybe an even more critical area for a lender. Asset quality. How healthy is the loan book?
Crucial question. And the news here is, well, pretty positive, actually. We're seeing clear improvements across the board.
Okay, like what?
Well, stage 3 exposure at default, or EED, basically loans significantly overdue, that came down quite nicely. It's at 2.62% now as of June 30th, down from 3.3% a year ago.
That's a significant improvement.
It is. And gross non-performing assets, GNPA, and net non-performing assets, NNPA, they also improved. GNPA is down to 2.62% from 3.29%, and NNPA is down to 1.30% from 1.68%. So fewer bad loans overall, and fewer after accounting for provisions.
And what about the provisions themselves?
The expected credit loss, or ECL, provisions the money set aside for potential defaults actually decreased. It's now Rs 5,051 crores, down from over 5,600 crores last year. And the provision coverage ratio for those stage 3 assets improved slightly too, up to 50.81%.
So lower bad loans and they needed slightly less set aside for potential losses.
Essentially, yes. Which, raises the important question, what does this improved asset quality really signify?
Right. What does it tell us?
It points towards effective risk management, doesn't it? It suggests they're doing a better job selecting borrowers, managing collections, or maybe the overall economic environment for homeowners is improving slightly. For a housing finance company, a healthier loan book is fundamental. It's crucial for long-term stability, profitability, everything.
Absolutely. A strong foundation. Okay, let's bring in the view from the top. The managing director and CEO, Sri Tripuan Adhikari, what were his key messages? I know he mentioned the company hit 36 years helping people own homes.
Yes, he highlighted that milestone.
And he talked about some strategic moves too, right? Like reducing lending rates after the RBI cut.
He did. And also introducing zero processing fees, both aimed at making housing credit more accessible, trying to stimulate demand.
That's a pretty big incentive for borrowers.
Definitely. He also emphasized their digital transformation, launching an updated website, focusing on a smoother, tech-enabled customer journey, which is, table stakes these days, but important nonetheless.
True. And his market outlook.
He expressed strong optimism, particularly for the affordable housing segment, pointing to, increasing urbanization trends and government initiatives like PMAY as key drivers, expecting strong momentum there.
Okay, so that's the strategic vision. How does that connect with their actual operations on the ground, their network, how they get loans?
Right, because strategy needs execution, and they certainly have the footprint. An extensive network. 10 regional offices, 23 back offices, dozens of cluster offices, over 300 area offices, even an office in Dubai, plus nearly 2,500 employees.
That's a wide reach.
It is. And they use diverse channels to originate loans. You've got home loan agents, HLAs, direct sales agents, DSAs, customer relations associates, CRAs, direct marketing executives, DMEs, plus their subsidiaries branches.
Lots of different avenues.
Yeah. And interestingly, HLAs, those home loan agents, bring in 56% of the originations. Shows the power of that agency network. And geographically, while 44% of business comes from the top 8 cities, a significant 56% comes from their other offices. So they have a really broad reach beyond the major metros.
Reaching into smaller towns and cities, too.
Exactly. The average ticket size for new loans in Q1 was about Rs 27 lakhs. And just reinforcing that focus we talked about, individual home loans make up almost 85% of the total loan book.
So putting it all together, the strategy from the CEO and these operational details, what's the takeaway?
Well, it seems like their operational strengths, especially that wide network and the multiple channels, are really well aligned to support the strategic goals.
Right, they can actually deliver on the affordable housing focus.
Precisely. Having that reach allows them to tap into the demand driven by urbanization and those government schemes. And moves like cutting rates or offering zero processing fees become much more impactful when you have the infrastructure to deliver them broadly. It feels like a cohesive approach.
Okay, makes sense. Let's round out our deep dive then by looking at the financial foundations, the company's overall financial strength, capital, liquidity, and maybe some key corporate governance points.
Sure. And the picture looks pretty solid here, too. Their capital adequacy ratio, or CRR, was a robust 23.20% as of March 2025. That's up significantly from 20.78% the year before.
That's a very healthy CRR, lots of buffer.
It is. Shows strong financial resilience. Tier ICR was also very strong at 21.70%. The liquidity looks good too. The liquidity coverage ratio was over 177% in Q1, so they can meet their short-term obligations comfortably.
Good. What about debt levels?
Their debt-equity ratio actually improved, down to 7.71 from 8.45 year-on-year. Total debts to total assets remained stable. Their borrowings, which are quite large, around Rs 271,000 crores, are mainly funded through non-convertible debentures, that's 55%, and borrowings from banks or the National Housing Bank, which is 31%.
And the cost of new borrowing?
The incremental cost of funds in Q1 was quite competitive at 6.97%.
Okay, solid financials. What about ownership and anything shareholders should be aware of?
Well, the parent, Life Insurance Corporation of India, LIC, remains the anchor shareholder with 45.24%. But there's significant holding by FIIs, mutual funds, other institutions too.
So a mix of institutional support.
Yes. And for those holding shares, the board set August 22nd, 2025 as the record date for the final dividend for the last financial year, FY25. That dividend gets paid within 30 days after it's approved at the upcoming AGM.
Got it. And any key governance or compliance points to note?
A few things. The Q1 results we've been discussing, they were unaudited, but received an unmodified review from the auditors, which is standard practice and a good sign.
Okay.
The security cover for the listed NCDs is strong, at 1.21 times, well above the 100% requirement. They also confirmed that the roughly 9,500 crores raised via commercial paper and NCDs in Q1 were used exactly as intended. No deviations.
Transparency there.
Right. And reflecting recent regulatory changes, the board constituted a specific review committee for identification of willful defaulters following a new RBI directive. Shows they're keeping up with compliance and emphasizing robust governance.
Good to see.
Oh, and a small operational point. Their registered office is moving to a new address in Kufra Parade, Mumbai, starting August 2nd. And finally, the 36th AGM is scheduled for August 29th, 2025, and it'll be held virtually.
Okay. Quite a lot covered there. So just to wrap it up for you, our listener, this deep dive into LIC Housing Finance's Q1 results, it really paints a picture of a company performing strongly, especially in its core area, individual home loans. Strong growth there.
They're clearly improving asset quality, which is vital. They seem to be managing costs well, strengthening their capital base, all while, navigating the market and trying to leverage government initiatives.
Absolutely. Solid performance overall, with that interesting strategic focus on the individual segment showing through quite clearly in the disbursement numbers.
Right. So maybe a final thought to leave you with. Yeah, perhaps something to chew on. Considering LIC HFL's really robust performance in individual home loans and that clear strategic focus on affordable housing, what might this tell us or suggest about the resilience and maybe the future direction of the broader Indian housing finance sector? Especially, as urbanization keeps gathering pace and those government incentives continue to evolve.
That's a really insightful question to ponder. What does one major player's success signal for the whole ecosystem? Great thought. Thank you for joining us on this deep dive. Keep exploring, keep asking questions, and we'll see you next time.